Welcome. This is Tom Alexander with Alexander Trading, and tonight we're going to do a review of the U.S. stock indices, and we're going to talk specifically, and you'll see this at the second part of this more than the first part of this, the market profile, auction market orientation to this. If you're not familiar with market profile, or you're not familiar with auction market principles, I will direct you to some free resources that you can avail yourself of if you're interested. A lot of what I'm going to show tonight, anyone will understand. What I want to do is to sort of frame the drop that we have seen in the past few days and put it into some historical context. I'll ask you, and this is an open question, are markets different now? Do you guys think markets are different than they've ever been before? Be thinking about that. Everybody has an answer. Everybody has an opinion about it. And it seems to me that the consensus is that markets are very, very different than they used to be. Here's what we're going to cover tonight. What do market profile, auction market principles suggest about price going forward? What followed similar dramatic sell-offs? And I'm going to go through the charts in just a minute. What is the technical picture telling us? I'm going to give you a general practical trade strategy you can use. And if you like, and if we have time, I don't know how long this will take, we can look at a few other markets, anything that you'd like to look at. Dramatic drops. Well, we've had a dramatic drop, and contrary to what people have gotten used to in the past couple of years in particular, or at least since late 2018, is the low volatility, but dramatic drops in the market are pretty commonplace. They have certain well-defined characteristics, among them being that they catch almost everyone by surprise. And of course, they're perfectly clear in hindsight, not so much in real time. So what I want to do now, I want to take a few minutes and go back through time a little bit. And let's just take a look at some past market drops. Now let me find my page. Here we go. I'm going to have to start with the S&P cash because the ES was not trading, didn't start trading until 1998. So we're going to start with 1987. And as we go through here, I'm going to be pointing out several different things. One thing that all of these drops have in common that I think you'll find highly unusual is that I traded every single one of them. I have been trading since 1985, and I have traded every single drop that you see here. I remember 1987 quite vividly because I had not been trading that long. It was an extraordinary, it was just a frightful experience. I was young and a young trader and really naive, and I knew nothing about the market and thought that I did. And this was a real wake-up call for me. It's a wake-up call for a lot of people, but it was a particular wake-up call for me. I have a great story about, I'll give you a real quick preview of a story that I'll tell again sometime, but I had started trading in 1985, and the popular trading vehicle at the time, it was similar to the ES, were the OEX options. And the OEX is a stock index of 100 stocks, and the OEX options were extremely popular. And I started trading those. I was a broker at the time, but I traded hundreds and hundreds of out-of-the-money OEX options, and I had the great misfortune of making a small fortune for me in a short period of time entirely because of luck. And that it turned out that it was bad luck that I made so much money so quickly because I thought I knew something and I thought I was smart, and I didn't. Well, I'm going to fast forward to the end of the story. I was short this week, this whole week. I had OEX puts coming into this week. Now, I can tell you these days because I remembered it so vividly. This was Friday. This was Thursday. Oops, sorry. This was Tuesday because Friday was one of the biggest down days in years, and I was long puts and went home long puts. And so when the market opened up, when the futures were down like, I don't know, 5 handles. Now understand, you're talking about, you're not even in the 300s on the S&P. So 5 handles was a big percentage. So when the market opened on October 19th, I had been long puts in low volatility from up here. And volatility, of course, exploded on Friday. And then when the market opened here, and you can see, I mean, it was just an extraordinary day. But I had the great idea that, and my puts were worth literally a small fortune. So I decided that I would cover my puts, and that was okay. But I had the better idea of going long. So I bought calls. Now, you can imagine what buying calls in this volatility environment itself did, but it was about 3 months, 2.5 months before any of those calls and they expired, but before the market even got back to the level that I bought the calls. So that's my experience in, in learning that I did not know what I thought I knew as a trader. And it set me on the path to understanding the market. And it is an understanding of the market that I teach. It's, you cannot make money if you do not understand the market. You can get lucky, you can make money for a little while, but you will not keep it. Every bull market that I have traded through and lived through has the proverbial bull market geniuses that think, oh, I've got it figured out, I know what to do, and I'm going to just do it until I am the richest man on the planet. And it never works. If you don't know what you're doing, the market will catch up with you. The market is the most humbling mechanism on the planet for everyone, and I am certainly the poster child for that. Now, so in 1987, the market fell 31% in 5 days. But what I want you to do, in addition to paying attention to the market drops, I want you to pay attention to what followed the market drops. And there's one thing that happened every single time, and then there's one of two things that also happened every single time. And I'll tell you the one thing up front that happened every single time we had a dramatic drop like this. We had a dramatic rally. So the market fell 31% in 5 days. Well, in a day and a half, it rallied almost 20% in 1987. Now, I'm just going to scroll through here. Okay, this was in 1990. The market fell 20% in a short period of time. Now, this was a fairly orderly decline because we had these pockets of balance. These are balance areas. And once again, if you don't understand what I'm talking about when I use some of these terms, I'm not trying to confuse you or use language you don't understand. It's just a balance is a consolidation. Balance is an auction market term. Now let's keep going. All right, this was 7.35%. This is not, this type of decline is fairly common once upon a time. And then 1995 was just absolutely extraordinary. I actually thought recently that the time period we were in mirrored closely 1995, because 1995 was absolutely relentless, and you really didn't get any volatility until February of 1996. This was the of the if you can make the case that the bull market that ended in 2001 that began in 1982, this was the strongest part of it in here. It was the most relentless part. And then you started to get some volatility in 1996. You had a 10.39% drop in 10 days. You can see you had the huge bungee jump here. You had this buying tail, and then you tested the buying tail, you formed another buying tail, and you were off to the races again. Then in 1997, there was a 12% drop. You can see the bungee jump here, huge retracement. This is 1998. Yeah, this was in the summer of 98. This was really a two-part drop. We fell about 11.5%, formed balance for a few weeks, and then dropped 15.5%, and then had a monster bungee jump and tested the low here. I actually think this could be what we might see in the next couple months. I think we're close to a low time-wise, and we're going to get this furious rally, and we'll see how far it carries. And then the test of that low would be interesting. But this, to me, right now, this would be Tom's best guess as to what's going to happen. And let's see. Oh, okay. I can go back to the ES now, which I'll do. ES started trading in 98. So there's some volatility in the summer of 98. Those of you who may have been trading then, we fell 11.5%, formed balance in here. You can see the bungee jump that occurred. And then we had another dramatic drop in 6 days, fell 16%. This is similar to the drop we have now, and then formed balance. But you can see that the initial move off of this was rather dramatic. Tested the low, dramatic move higher. This was about 11.75% drop, but it was fairly orderly, and it took, weeks. This is a pretty sharp drop in a short period of time, about 13%. This was in, now this, a couple things I want to point out about, this is the 2000 top. Everybody seems to want to, they're sitting there waiting to catch the big move. And even if they catch the big move, they give it back. They give it all back, because the market is going to rotate. It's going to balance in some time frame. And in 2000, it was the formation of this top took months and months, and it was extraordinarily choppy. We could see that now. You just don't know. So you have to be careful. Even if we've made a bull market high, it could be another year before the market really rolls over. And that's if we've made a bull market high. There's no way to know that now. And quite frankly, from a trader's perspective, it doesn't matter, because there are things that we could use as traders to identify trade opportunity. And that's really all you want to do as a trader. You don't want to be, I've never wanted to be a market guru predicting market turns and how far they're going to go and projecting price levels. The only thing that I use in regard to projecting price levels, I lean on previous market activity, and I lean on the auction process itself. The auction process itself does provide you with something that is predictable to a point. I'll get into that a little bit later. But here are a couple of more dramatic drops in that bear market that began in 2000. But you can see this bear market, and it was a pretty vicious bear market. I mean, there were plenty of long rallies that lasted months, sharp rallies, declines within those rallies. And then here's a 20% drop in a relatively short period of time. But even in bear markets, it's important to notice the rallies that you get. You get much sharper corrections in bear markets and more of them than you typically do in bull markets. That's why a lot of traders that trade the stock index futures like bear markets. They can be easier to trade. And then here we are in 2008. And this was a very dramatic, let's see, this is where, okay, here we go. This is 2007. This is late 2007. We had a 17% drop. And then this is the quote unquote crash part of the bear market that began in 2007. You had 5 or 6 days in October of 2008 where the market fell 28%. But look at the rallies that occurred. I mean, you had a rally that retraced, I don't know, 60% almost. Let's see, I can tell you. No, sorry, 27%. Back up. So expect it, regardless, even if we're in a bear market, you're going to get furious rallies and opportunities to sell the market. You're going to get opportunities to buy the market. And that brings us back. Let's see. This was a pretty dramatic drop. In 2010. This was a pretty dramatic drop. All of it, hopefully you can visually recognize the commonalities that you're seeing here. Okay, this was 2014. This was about an 8% drop. That's not that dramatic. This is about a 13% drop. Again, the bungee jump higher. And if you're reading the headlines, you would think this is the first time in history the market's ever fallen that far, that fast, and there's never been anything like it. And that's just not true. Now, that was dramatic, but you know, you can see for yourself it's not that unusual, and it's not too far out of normalcy. All right, this is a 12% drop back just 2 years ago, but the media is completely forgotten about that one. %13 in December of 2018. So in 2018, you had 2 quite dramatic drops. And that brings us back to the present drop. Now, I think one of the reasons that there's so much attention being paid to this is because it just dropped out of the sky from top tick of the bull market. And I understand the exogenous event itself does give pause because there's uncertainty around exactly what that virus is going to do. But we've had debt crises, we've had terrorist attacks. It's always something where there's uncertainty that creates an environment like this. It happens to be this coronavirus now, but it's more similar to previous drops than it is different. That's my point. Now let's go back over here. And here we are, dramatic drop. So the commonalities, and hopefully you caught some of those commonalities. We had dramatic rebounds in every single case. We had either a V bottom or balance. We generated extreme market internal conditions, and there are well-defined characteristics. Now, I want us to go through a little bit. I want to spend some time with you and explain extreme market internal conditions. Now, I'm not a big indicator user. I think indicators are misused. I don't think they're necessary, but there are a couple of things that I have used over the years that are extremely useful. And this is something I've used for most of my 36, 35 plus year career. And now let me explain what these are, okay? Let me find, here we go. This is market internal information, and they look like oscillators, but this isn't a stochastic or an RSI or an order flow or any of that stuff. These are simple moving averages using NYSE internal market data. The red line is the 10-day moving average of advancing issues on the NYSE. The green line is the 5-day moving average of advancing issues of NYSE advancing issues. And below here you see breadth. This is the net advancing minus declining issues for the day. Now, I've used this most of my career. It is a blunt instrument, okay? You can't rote trade this, but it can give us clues into the auction process. It is the world's greatest sentiment indicator, especially in corrections, downtrends, bear markets. It's not nearly as helpful in a bull trend because you have divergences after divergences after divergences after divergences. So there's so many false positives in bull trends that it's not helpful, not particularly helpful. I mean, there'll be a lot of people that point to the divergence here, but they miss the divergence here or the divergence here or the divergence here that meant nothing and divergence here. You know, I can go on and on and on. So you know how that game is played. But now to the downside, it's a different story. This can give us really good information, and it's one reason I think we have either put in a low on Friday or we're really close to it. And the next thing that comes is the bungee jump. Now, I'm going to go back. I'm not going to sit here. I'm not going to make you sit through me going through the past 10 years, but I just want to go back far enough to give you a sense of the extreme levels that these readings are registering now, okay? The 10-day moving average of advancing issues reached the same level we're at now back in December. I'll tell you this up front. Here's the spoiler of this. The 5-day moving average of advancing issues has never been this extreme in the data that I have. The 10-day, it has been. It has been more extreme one time. That was in 2008 for a very short period of time. But, and I'll just scroll and you can just sort of see here. All right, here this was 2016, but again, you can see the 5-day moving average of advancing issues was way above where it is now, and the 10-day was right at it. So, excuse me, again, I'm not going to make you sit through me going through all the way back. I think you see enough data now to get an idea that, yeah, this is an extreme by this measure, and it is. And this is one of the reasons that I think we're near a short-term low, at least a short-term low. Okay. All right, I want to tell you a little bit. This won't take but 60 seconds. I want to tell you a little bit about Alexander Trading and myself. I've been trading for 35 years. I started in 1985, in the mid-1980s, as a stockbroker. I've owned a brokerage firm, a futures commodities brokerage firm. It was primarily institutional for 9 years. Traded large private accounts. I've traded institutionally. I presently manage family accounts. I am also presently a partner trader in a registered hedge fund. I am an active trader. I trade every single day. I have been trading in front of a screen my entire career. I have never spent a day on the floor. It's a very, very different world, trading in front of a screen versus trading on the floor. I've been a student, practitioner of market profile and option market principle for 34 years. Been a trading educator for the past 17 years. My business, what I do, I provide valid resources centered entirely around auction market principles. These methods can be used to trade any market in any time frame. Stocks, ETFs, it doesn't matter. Any asset, options. We have an options program. Auction market concepts are ideally suited for options trading. You will never find anything on the internet having me say trading is easy. Trading is not easy. It takes time, focus, effort, and money to reach any level of proficiency. And as far as trading is concerned, ignorance is extraordinarily expensive. If you're trying to learn to trade on the cheap, you're going to pay a very dear price, believe me. I'll let you go look at the resources that I have available. You can find them on Alexander Trading, www.alexandertrading.com. There's a lot of stuff on the website, or you can email me if you have questions about what I'm doing or any of the products that I offer. So what is the present condition of market internals? We're pretty extended, aren't we? So that's evidence on the side of maybe we're going to get a bounce. As I was putting this together, I have done webinars for 17 years, and I will go back and I will try and cut and paste stuff so I don't have to recreate the wheel every time I do a webinar. And I ran across this slide. This is a slide from a webinar that I did in 2012, I think, 8 years ago. And it is so true. You know, traders are always complaining that what they're doing, it works so well, but this changed and now what works so well doesn't work. Everybody's always complaining that the markets aren't liquid, they're not fair, they're not accommodating, they're not volatile enough, they're too volatile, they're being manipulated by the government, Goldman Sachs, central banks, politicians. There's too much government, not enough government regulation. Taxes are too low, too high. This has been going on since markets were created. It's just the way it is. If your method, if your whatever thing you used to trade isn't working now, it's not the market, it's the thing. Have markets changed? These are profile views from different time periods of the stock indices. I've used the Dow because the S&P wasn't around in 1929. So you can see this. The reason I did this little exercise, this is that Gaussian shape that's ubiquitous in markets. It doesn't matter if it's lean hogs or rough rice or the S&P mini. The markets we trade follow an auction process. This auction process of development leaves this footprint over and over and over. All markets, all time frames. This is the Dow from January 1929 to June of 1929. This is the Dow 1932, 1933. This is the S&P September of 2000, January of 2000, September of 2000. This is the S&P July 2002, May 2003. This is the S&P April 07 to December 07. And this is October 2008, 2009. So I would say, I ask you guys the questions, have market changed? The auction process has not changed. Now, this was also from a webinar I did years ago, and I found it when I was looking for stuff. These are this is the S&P Mini, okay? This is the S&P Mini, right? This is May 13th, 2008. This was it was about 12 handles, okay? We had about 12 points in here. The VIX, the volatility index, was 18, and the 10-day average true range was 21. This was October 16, 2008. This is about 85 handles, 85 points. The VIX was 67. The 10-day average true range was 94. They look identical, don't they? The thing that's identical about both of these is that they're both auction markets. Completely different environment, but the auction process is extraordinarily elegant and unique. This auction process of development is unbelievable. Now, this is Friday. This was February 28, 2020. At 143-point range, VIX of 49, a 10-day average true range of 49, a 5-day average true range of 105 handles, 105 points. The auction process has not changed. As a trader, and 1A, as a trading educator, it excites me when I see times like this when nobody knows what the hell's going on, except people who understand the auction process has not changed. It provides a base model for any number of trade plans and trade strategies that is limited only to the imagination and the aptitude of the trader. So how do you trade this? Well, the auction process of development creates levels, key reference areas from where there is a greater than random probability of a sharp move. This is where there's a consistent edge. You want to be trading at certain points in time that you can identify through this auction process. And again, this applies to you guys that only want to take trades intraday. It applies to you guys that only want to position trade. You trade the market, you trade the auction process, regardless of the time frame you trade. The primary key reference areas, there are 3 primary key reference areas in every auction structure. There's the upper and lower extremes of the auction and the high volume node. Trades near one of these 3 key reference areas carries an inherent positive expectancy. That's saying a lot. Okay, guys, that's going to wrap up the part of the presentation. Now, in just a minute, if you like, I'll move back over into the charts and we can take a look at gold and crude and maybe the euro and or anything you guys want to look at. But if you want to know more about auction market trading and market profile, if you go to my website, you can sign up for a free course. It goes into some of these concepts in more detail. And so at this point, I will I'll go back to the charts and let's take a look. Let's take a look at gold first, okay? So this is a market profile chart of gold. Now, this is the daily chart. Each one of these profile units is 1 month. We've just begun the month of March. So we have traded into a very important key reference area. That is the high volume node from the previous month. So gold is in an inflection point right now. Gold is trading in one of these 3 primary key reference areas that I just discussed with you. So it's important that gold hold about 1563 under a bullish assumption. Let's take a look at crude. Now I'm going to show you a bar chart of crude, okay? And that's something else. People associate me with market profile, and that's fine. But I am not a market profile trader, and I don't train people to be market profile traders, and you don't want to be a market profile trader. What you want to be is an auction market trader. The market profile graph is just a particular view of data. It's a particular configuration of trade data. It can be a it is a very, very useful tool in helping to identify market condition through the lens of the auction market process of development. There are times when a bar chart is actually more useful than a market profile chart. So any chart you use is a tool, is a means to an end, not an end in itself. There is no magical chart. So we're going to look at crude, and you can see crude is sitting on in the edge of the abyss. This is a key reference area from a market profile perspective, from an auction market perspective. There is going to be a sharp move out of this area. There will be a sharp move out of this area. When? I don't know. What I'll do as a trader is go down in time frame. When I'm interested in trading crude, I'll analyze it the exact same way in those smaller degree time frames so I can measure my risk per my account size and find appropriate trades. But crude is at a really, really, really critical level right now. If I had to trade one contract and could only trade one contract, I would trade crude. The reason I would trade crude is because it trades in all time frames great. It is a great trader, so to speak. Day trading it, swing trading it, position trading it, crude is a wonderful contract. I get asked that question all the time. If there was one contract you said that somebody said, okay, Tom, you can never trade this contract, and then I'm not talking about rough rice. If I had to pick between, let's say, crude and the S&P, I would drop the S&P in a heartbeat. The ES, the S&P, the U.S. stock index futures are the most difficult contracts to trade in all time frames of any contract. That's just a fact. And I trade them every day. I'm just telling you the truth. Now let me show you one last thing here. Here we go. This is what I want. I mentioned before there are certain things that the auction market process enables you to predict. And I'm going to make a prediction now, and you're going to hold me to this. I'm going to predict that you're going to see a more two-sided trade between now and the end of the second quarter than we're seeing right now. And I'm going to predict that that two-sided trade is going to resemble something along the lines of this. Or maybe this. So I am going to leave you with that prediction. And I want to thank all of you for showing up and taking your time on a Sunday evening. Are there any last questions? Well, again, thank you. I have recorded this, and I will send you the recording. If you have questions, get in touch with me. Thank you so much. Have a great evening and have a great week.